Sorry to break the news to you, but you've been investing all wrong. Well, if you're an angel investor and you've been taught the normal way to invest, then what you've been told is that every time you invest in a startup, you need to make 10 times your money back, or at least you need to think you're going to make 10 times your money back. Well, that's just not true. You see, where the 10x comes from is the paradigm of investing that's now being called California capitalism. It's the venture capital model of investing, where you look for a giant market opportunity and a high growth model and a large sum of money to put into it. And if all goes well, then someone will buy that company or that company will go public and you'll get your 10x or 20x or better return. Well, that's all well and good, but there are lots of other companies you can invest in companies that you may think today are uninvestable, when in fact it's just the style of investing that you've been taught that's the flaw. Now, traditionally, there's just two ways to invest: debt and equity. Now, debt doesn't work for anyone. Startups, they can't afford to pay the fixed interest rate that comes with debt. They don't have enough revenues. You can't charge enough interest for it. On the equity side, we all know how that works. You put in a bunch of money into a startup, more people put in after you, everybody waits pretty much forever for there to be an exit. If it's a loss, you know about that sooner than later. Makes you think all you know how to do is invest in losers. Meanwhile, the winners take 6, 7, 8, 9, 10 years before they return anything to you. I'm here to tell you there's another way. And that way is revenue-based investing, or more generally, structured exits. Now, how this works is rather simple. You, the investor, you hand over some money to a company, and they promise you to pay a fixed percent of something, usually top-line revenues. And they pay this back to you on a monthly, quarterly, annual basis until they've paid you back some multiple of your original investment. 2 times, 3 times, 4 times, 5 times the cash on cash that you gave them. Well, this works for startups. It works really well because they don't pay you anything until they have revenues. And when they do have revenues, they're paying you a fixed percentage. So they can afford it as long as their margins are big enough. And it works for you too, because you're getting your money back as the company succeeds. You're not waiting around for someone else to buy the company. There's no exit here in the traditional sense. It's a structured exit, as in you're getting back your money and then some upon success of the startup. This can be structured either like debt or like equity or something in between. If it's a revenue-based debt instrument, well, you're getting that fixed payment kind of like a variable rate loan. In the case of the equity, the way it's really structured is that you, the investor, you're buying shares, and then the company is repurchasing those shares from you using a fixed percentage of their revenue to determine how many shares to buy back at a price that you've determined at the beginning of the transaction, a price that returns back to you 2 or 3 or 4 or 5 times the cash you gave them. So this is not new. It's been going on for thousands of years, usually in the mining and the oil and the film industries, but it's kind of new in the startup realm. I found this in a few funds doing growth capital. What they do is they structure them as revenue-based loans for generally companies that don't have any venture capital or angel investors behind them, bootstrap companies. And they structure them rather simply: $100,000 or $200,000 or $300,000 loan that is paid back with a small fixed percentage of top-line revenue, generally a single-digit percentage, and a 2x multiple. So that $100,000 goes in as a loan and it gets paid back over 2 or 3 years at $200,000. And when you sit down and you compute the internal rate of return on what that would be, which is basically what the equivalent interest rate would be if it were fixed rate, well, it comes out to be the right amount for a company at the growth stage, somewhere between 15 and 20%. We use a structure like this at my accelerator, Fledge, as well, but we do it in the form of equity. So for $20,000 and lots of help, we get 6% ownership in the company. That's kind of standard for accelerators, 6%. But what we're really buying is 4% of future revenues. We're getting 4% of their next $2 million in revenues. Do the math, that's $80,000. So we give them $20,000 in cash. They give us back $80,000 in cash. That's a 4x multiple. But really, it's a little bit more than that, because what we do is we structure it so that they're buying back half our shares for $80,000, leaving us 3% ownership for any upside that we would otherwise miss. So if there is a 10x, great. We make 5x on the residual equity, the non-redeemable equity, and we make 4x on the other. So we put a little bit of money out on the table, but we can now invest in companies that may never get an acquisition, or companies that turn into a lifestyle company, or companies that grow for a while and then stop. Normally those would be zombies in your portfolio. And it's not just Fledge. Here in Seattle, we've done about a half a dozen angel syndicate deals using structures like this. We saw 2 deals come by that raised about $500,000 apiece using revenue-based equity again, where the investors got a 3x return on their shares for 2/3 of those shares, and then the rest went long. Another deal that raised money here in Seattle was Earth Equity Farms. This is an organic grower of fruits and vegetables down in Mexico. Don't ask me why they got funded in Seattle. You know, these things just happen. Well, the terms for Earth Equity Farms were, again, redeemable equity, in this case annually, and they were buying them back for, again, about 2x cash on cash, with most of the shares repurchased with a few left over. But the new twist in this model was that those redemptions were optional. So what was really fascinating to me in seeing this deal was that we could put normal equity investors and redeemable equity investors side by side in the deal, and they're redeemed once a year, and at that time, each year, each investor gets the option of whether they want to be redeemed or not. And so those who love this idea, those who want cash flow from their investment, can take their earnings back sooner. And those that think that this company is going to get bought, that it's going to be huge, well, they can just hold on and wait. So today we're going to look at one more of these deals, one based on a true life story. The real company is called Deep Roots Foods. They were a competitor in the Social Venture Partners Fast Pitch competition here in Seattle back in 2015. Now the case is just called Food, F-U-D. Really, it's the same company. We've just obfuscated a couple of facts and simplified some of the numbers just to protect their business plan. All right, it's a really simple idea. They are a food co-packer for small local brands. And if you're unaware what a co-packer is, well, that's really a factory for other brands, right? If you're a brand, a small brand, bringing a product to market, bringing products to markets, plural, well, then we wind up hiring a co-packer to do that. You don't build your own factory to make the food you need. You'd only do that when you're a giant brand. All right, so Food here, they're proposing, in this case, and they're doing this in real life, they're proposing to build out a facility in Olympia, Washington, which is a disadvantaged neighborhood. It's the capital of Washington State, but nonetheless, it's counted as a disadvantaged community. And they're going to build out a co-packing facility. So they need some money. And in this case, in the competition in real life, they want $130,000. We're going to round it to $150,000 for the case. And they're going to use that money to go buy equipment and set up the facility and start making food. And then the brands take the food off their hands and go and deal with putting it into the stores. That's not their business. They just have to make the food. Right? It's actually a really good business when you look at the financials, because they get paid up ahead of time. Right? If you want to hire a co-packer, you pay for all the ingredients, you pay for all the labor ahead of time, and then the food gets delivered, so you don't have any payables. And then you don't have to worry about marketing. All you really have to worry about is that the brands that are using your facility sell their product and grow. And since you're worth 12, 18, 20 brands in this case, then even if a few of them fail, it doesn't matter. You fill in the rest with the other brands. All right, so the question is, how do you invest in this style company? This is not a company that's ever going to return a 10x. This is not a company that's going to grow 1,000 times in scale. With the $150,000 that they're asking for in this case, plus the other money that they've raised themselves internally and from loans, that will build a facility that can do a few $1 million in business. And the question is, what should the structure be that is going to return enough to the investors to make them want to invest? And in this case, we're gonna take that question away from you on whether or not you're interested. For the case, you are representing either yourself or family office or investment advising some other rich person, and they like this deal. They think this is a great business. They love the idea. They love the disadvantaged neighborhoods. They love the founders. They love everything about this deal, and they want to invest. And it's your job to figure out, what should the terms be? How should we structure this deal so that not only you are happy as an investor, or your investors are happy as investors, but the entrepreneur would also take this deal. It has to be good for them too, right? So the big question is, what's the reasonable rate on return on this investment? How long should the investment last? The wonderful thing about revenue-based investing or structured exits, you can figure that out ahead of time. And then what other preferences do you want in this deal? Do you need a seat on the board? Do you need any other controls? What about liquidation preferences? What happens in change of controls and so forth? Right? You get to set all that up as well. This is kind of, since we're breaking the model of standard equity, we're asking the question of which of those terms that you're used to in preferred equity should stay on in this deal as well, or what else should be added that isn't in those deals. Right? And just for one last piece here, just think about the fact that other people in the room are going to bid too. So think about this as the case where there's lots of bidders. There's a lot of interest in this company. You want to put forth your best and final offer, not your first offer, but your best and final offer so that the entrepreneur can pick from amongst all the deals in the room. All right, to help you, we've given you a revenue-based analyzer, which is a spreadsheet that was actually used in this deal to compute the rate of return, to try and figure out what the right percentage of revenue was and all the other terms. And it is a little biased in that it's based on top-line revenue because everything we do at Fledge is based on top-line revenue. But you can change that. You can make an estimate for their gross margins and put in their profits and whatever else you think is correct. All right? That make sense? All right, well then, have at it. Okay, I hope you had fun doing that. And now let me tell you what happened in the real world. Well, Social Venture Partners said they were going to give $130,000 to this company, contingent on them raising another $20,000. And that's just what happens in our competition. We don't want to be the only investor, so we almost always say, find a little bit more. In this case, $20,000 more just to show good faith. And they did. They found an equipment loan for $20,000 from a bank. All right, so that was an easy one. Now the question is, how did we structure the $130,000? Well, we did that as a revenue-based loan with a 2x multiple. So we're expecting to be paid back $260,000 with 6-month payments, twice-a-year payments. All right. Now the trick was, what percentage of revenue did we choose? We did choose top-line revenue, and we did that because I was the lead on this, and we always choose top-line revenue here in Seattle. It's the simplest. The trick here was that we didn't know how risky this business was. There was no one in our investment community of 15 members that had any experience building a co-packing facility. So we had a pretty good debate on whether this was a high-risk business or whether this was a pretty easy operational business with fairly low risk. And so what we decided to do is something that I had never seen before, never seen anywhere, which is to use hindsight to try and tell us what the risk was. And we only changed it a little bit. So what we did is we said, great, you the entrepreneur, you give us a bunch of projected revenue numbers. And of course, being investors and being savvy investors, we knew those numbers were wrong. So what we said is, all right, we'll start the loan at 5% of top-line revenue. And if you succeed at hitting the numbers, if you hit the numbers or do better than that, well, then we'll drop the percentage of revenue down to 4%. And what we always do is we whack those numbers down by about half. And we said, these are our conservative numbers. And if you hit those numbers or do worse than that, then we're going to increase the loan up to 6%. So in this case, and we're going to do this once a year, we're going to look at the results, the actual results versus the projected results. And if they are somewhere in between, we'll keep them at 5%. If they're doing really well, we'll drop to 4%. And if they're doing poorly, we'll drop to 6%. And that moves the IRR around between 18 and 22%. So it doesn't move it around a lot, but it lets us adjust a little bit, looking back in time to see whether or not this truly was a easy to do business or a hard to do business. So how are these investings faring in real life? Well, it's too early to tell. So Fledge is 4 years old, and we've done over 50 of these revenue-based equity investments. And then in Seattle, these others that I talked about with the angel syndicates, I'm personally in 2 of them, and they're also too early to tell. The oldest is about 3 years old. So great. In 5 or 6 or 7 years, we'll be able to tell you what the actual return on investment was for these structures, and we'll tell you about the successes and the failures. But so far, everything looks promising. So there's a bunch of companies that are paying back or buying back their shares. There's companies that are paying back their loans. And what's really nice about this is everyone's in alignment. The nicest part about this structure is that there's no stress about trying to get to exit. Right? If the companies grow a little slower than they expected, and all companies grow slower than they expected, Well, then you just go to your spreadsheet and you plug in the actuals and you see that your return on investment is going to drop from, let's say, 22 to 18. Oh, well, that's still not bad. It doesn't go to zero. It only goes to zero when the companies declare themselves dead. And so far, we've had very few of them that declared themselves dead. Right? Nice thing about impact investing is you get entrepreneurs who are just so excited about what they're doing that they're really not going to give up unless they've run out of everything, run out of money, run out of time, totally burn themselves out. And so far, these structures are working rather well. And it's opened up a huge new world of new companies that otherwise wouldn't be able to be invested by angels because they're never going to make a 10x return. I hope you learned something today, and hope you take those learnings and go out in the real world and change some of those convertible notes into redeemable structures, revenue-based structures, so you can make some money back and do some more investing. If you have any questions about this, you can contact me, Luni, Luni, at fledge.co, or Luni, Luni, at aviary.vc. Thank you.